Alright, before we get into anything else today, I need you to stop whatever you're doing and pay close attention, because what I'm about to share with you could directly affect your bank account, your Social Security deposits, and your financial security in 2026. Now I know that sounds alarming, and honestly, it should, a little bit. Not because I want you to panic, but because thousands of seniors across the country are completely unaware that the IRS has quietly ramped up its monitoring of personal bank accounts this year. And the accounts they're watching most closely? They look a lot like yours. We're talking about regular, everyday transactions, the kind you make every single week without thinking twice, depositing your Social Security check, moving money between accounts, receiving a little help from your kids or grandkids, selling something online, things that feel completely normal, and for the most part, they are. But here's the problem. The IRS doesn't always see it that way, and when they flag something they don't understand or can't easily explain, the consequences can be severe. We're talking frozen accounts, unexpected tax bills, penalty letters showing up in your mailbox, and a bureaucratic nightmare that can take months, sometimes years, to untangle. And here's what really concerns me about this. Most seniors don't find out their account has been flagged until something goes wrong, until the money isn't there, until a check bounces, until they get a letter with very official-looking language that makes their heart sink. By that point, the damage is already done. So today we are going to walk through the 5 specific bank transactions that the IRS is watching most closely in 2026, why they're watching them, what triggers their system, and most importantly, what you can do right now to protect yourself. We're going to cover this in plain, simple language. No tax jargon, no confusing legal terms, just straight talk, because that's what you deserve. Let's start with the first one, and this one catches more seniors off guard than almost anything else I've seen. It's called structuring. And no, you don't have to be doing anything wrong for this to become a serious problem for you. Here's how it works. Federal law requires banks to automatically report any cash deposit of $10,000 or more to the IRS. That's been the rule for decades. But what a lot of people did, trying to avoid the paperwork and the attention, was start making smaller deposits, like depositing $4,000 one day and then $3,000 a few days later, and maybe another $2,000 the week after that. Seems harmless, right? You're just managing your money the way you always have. Wrong. The IRS and your bank are trained to spot exactly that pattern. It's called structuring, and it is actually illegal, even if every single dollar you deposited was completely legitimate. The law doesn't care about your intentions. If the pattern looks like you're deliberately keeping deposits under that $10,000 threshold, your account can be flagged, investigated, and in some cases, frozen or seized, without any prior warning. And this is where things get serious because this law, it's called the Bank Secrecy Act, was originally designed to catch drug dealers and money launderers. But in practice, it has swept up hundreds of ordinary law-abiding Americans, farmers, small business owners, retirees, people who grew up in a time when you kept your money private and you didn't trust banks with large sums all at once. So what should you do? If you regularly deal with cash, whether from selling things, doing part-time work, or just how you prefer to handle your money, be aware of this pattern. If you ever do make multiple deposits in a short time period, make sure you have a clear, documented reason why. Keep receipts, keep records, and if you're ever unsure, talk to a tax professional before the IRS comes knocking. Now let's move to the second transaction the IRS has its eye on in 2026, and this one is especially important for anyone who has children or grandchildren helping them out financially. We're talking about large cash gifts or transfers that come in without any explanation attached to them. Now, your family loves you, and sometimes maybe your son sends you a few $1,000s because your car needed work. Maybe your daughter transferred money to help cover a medical bill. Maybe your grandkids chipped in for something. That is beautiful. That is family. But the IRS doesn't see a heartwarming family moment. They see an unexplained deposit of funds that they want to understand. Here's the thing most people don't realize. There is a federal gift tax law that governs how much money can be given to any one person in a calendar year without triggering reporting requirements. In 2026, that annual gift exclusion sits at $18,000 per person. So if someone gives you more than $18,000 in a single year and it's not reported correctly, both the giver and the receiver could end up in hot water with the IRS. Now, in most cases, family transfers under that amount amount are fine. But what triggers the IRS monitoring system isn't just the amount, it's the pattern and the lack of documentation. If you're regularly receiving transfers from multiple people, or if the amounts seem inconsistent with your reported income, the system takes notice. And here's what makes this particularly tricky for seniors. Many of you are on fixed incomes, Social Security, maybe a small pension. So when a few $1,000s suddenly shows up in your account from an outside source, that can look unusual to the IRS's automated systems, especially if it happens more than once. The protection here is simple but important. Keep a paper trail. If a family member helps you out financially, even with the best of intentions, have them note what the transfer is for. Keep a record on your end too. A simple note in a notebook or a saved text message can be the difference between a quick explanation and a months-long audit. All right, let's keep going because the third one on this list is something millions of seniors are doing right now, and almost none of them know it could be a red flag. I'm talking about regular deposits from side work or extra income that isn't being reported as taxable earnings. Now, let me be clear. I'm not accusing anyone of cheating on their taxes. In fact, most seniors I speak with don't even realize that certain types of extra income are taxable. But the IRS absolutely considers them taxable. And in 2026, they have more ways than ever to find out about it. Here's a common scenario. You're retired. You've got time on your hands and skills other people need. So maybe you do a little bookkeeping for a neighbor's small business. Maybe you sell handmade crafts online. Maybe you tutor a few students from the neighborhood. Maybe you mow lawns in the summer or watch someone's pets. These feel like small things, personal things. But if you're receiving payments through Venmo, PayPal, Zelle, Cash App, or any other digital payment platform, and those payments add up to more than $600 in a year from a single source, that payment platform is now required by law to send a tax form directly to the IRS. This rule changed a few years back, and it caught a lot of people completely off guard. The threshold used to be much higher, over $20,000 with at least 200 transactions. But the new rules dramatically lowered that threshold. And the IRS extended its enforcement of this rule going into 2026. So, if you've been getting paid through any of those apps and not reporting it on your taxes because you figured it was just small, casual money, your bank and those platforms may already be reporting it without you knowing. And when the IRS compares what those platforms report to what appears on your tax return, a mismatch can trigger an audit or a notice. This doesn't mean you have to stop doing side work. It means you need to track it, report it, and potentially set aside a small portion for taxes. A tax professional can help you figure out the right deductions to minimize what you actually owe. And for many seniors doing casual side work, the tax bill is smaller than you'd expect once deductions are applied. Now, if you're finding this information valuable, and I really hope you are because this stuff matters, I'd love it if you took a second right now to hit that like button and subscribe to this channel if you haven't already. We cover Social Security updates, Medicare changes, IRS rules, and financial protections for seniors every single week. And it's all free, it's all in plain language, and it could save you a lot of money and stress. Hit subscribe so you never miss a video like this one. Okay, let's talk about the fourth transaction the IRS is closely monitoring in 2026. And this one I want to spend a little extra time on because it involves something very close to home for a lot of seniors, and the consequences of getting it wrong are significant. We're talking about distributions from retirement accounts. Specifically, required minimum distributions, or RMDs, and early or unexpected withdrawals from IRAs, 401ks, and pension accounts. Now, if you're over 73 years old, the IRS requires you to take a minimum amount out of your retirement accounts every year. This is called your required minimum distribution. The idea is that since you got a tax break when you put that money in, the government eventually wants its share when you take it out. And every year those withdrawals are reported to the IRS automatically by your financial institution. Here's where seniors run into trouble. Some people take out more than their required minimum, maybe for a home repair, a medical expense, a trip to see family. And some people accidentally take out money in a way that doesn't follow the rules. Maybe they rolled over funds incorrectly, or they took a withdrawal from the wrong account, or they didn't realize that a certain type of transaction was treated differently for tax purposes. What happens next might surprise you. Even a small mistake in how you handle a retirement account withdrawal can result in a penalty of up to 25% of the amount that wasn't handled correctly. That's on top of the income taxes you'd already owe. And if the IRS spots an inconsistency between what your financial institution reported and what you put on your return, or if you didn't file a return because you thought you didn't have to, That discrepancy goes straight into their system as a potential flag. There's also another layer to this that most people don't realize. If you inherited a retirement account from a spouse or a family member in recent years, the rules about when and how much you have to withdraw have changed significantly. The Secure Act and its updates have reshaped the entire landscape of inherited IRAs, and many people are unknowingly violating rules they don't even know exist. Here's what I want you to do. If you have a retirement account of any kind, an IRA, a 401k, a 403b, anything, sit down with your financial advisor or a CPA this year and go over your distribution schedule. Make sure you're taking the right amount at the right time. Make sure your beneficiary designations are up to date. And make sure you understand what happens to that account if something happens to you, because your heirs could be the ones facing the penalty if things aren't set up correctly. This is not something to put off. The IRS doesn't give much grace when it comes to retirement account rules. They consider this a priority enforcement area going into 2026, and the tracking systems they use are automated, which means they flag first and ask questions later. All right, we've made it to number 5. And I want you to stay with me here because this last one is perhaps the most misunderstood, and in some ways, the most dangerous, because it involves the Social Security benefits so many of you depend on every single month. Here's what's happening. The IRS, in coordination with the Social Security Administration and certain state agencies, has increased its monitoring of seniors who may be receiving Social Security benefits while also having unreported income that could affect either their tax liability or, in some cases, their benefit eligibility. Let me explain how this works in practice. Most seniors know that if you're under a certain age and you're still working while collecting Social Security retirement benefits, there are earnings limits. If you earn too much before you reach your full retirement age, your benefits can actually be temporarily reduced. But what a lot of people don't know is that once you reach full retirement age, those earnings limits go away. But the tax rules around Social Security absolutely do not. Here's the piece that catches people off guard. Depending on your total income, including Social Security, retirement account distributions, investment income, and any earned income, up to 85% of your Social Security benefits can become taxable. And if the IRS sees bank deposits that suggest your income is higher than what you've reported, they start doing the math themselves. And their math doesn't always favor you. This is especially relevant right now in 2026 because the IRS has expanded the data sharing agreements it has with financial institutions. They can now more easily cross-reference deposit activity, 1099 income forms, Social Security benefit statements, and tax returns all at once. Their systems are specifically designed to spot seniors who may be receiving income, even small amounts, that isn't being properly accounted for. Now here's something that's genuinely unfair, and I want to be honest with you about it. Sometimes the IRS flags accounts not because someone did anything wrong, but simply because the data doesn't match up perfectly. Maybe a form was filed late. Maybe there was a clerical error at a bank. Maybe a 1099 was sent to an old address and you never received it. And yet the burden falls on you to prove your innocence and sort it out. That process can take months. It can be stressful. And in the meantime, if your account is frozen or your refund is held, it can create real financial hardship. So here is what protection looks like for this particular issue. First, every January, when you receive your Social Security benefit statement, the SSA 1099, keep it. File it with your other tax documents. Second, if you receive any 1099 forms from banks, investment accounts, or anywhere else, compare those to your records and make sure everything matches. Third, and this is critical, do not ignore any letter from the IRS. Even if it seems like a mistake, even if you're sure you did nothing wrong, ignoring IRS correspondence only makes the situation worse. Respond promptly, even if it's just to say you're gathering information. And if you ever feel overwhelmed by IRS correspondence, remember that you have options. You can call the IRS directly at their seniors-specific helpline. You can work with a certified tax professional or a low-income taxpayer clinic if cost is a concern. Many communities also have free tax assistance programs designed specifically for seniors, such as the AARP Tax Aid Program. These volunteers are trained and IRS certified, and they can help you make sure your returns are filed correctly and your accounts are protected. Now, I want to step back for a moment and talk about the bigger picture here. Because I think what underlies all 5 of these transaction categories is one simple thing. The IRS wants to make sure that what they see in your bank account matches what you tell them on your tax return. That's really it at the core. They're not out to get seniors specifically, but their systems are blunt instruments. And when you're on a fixed income, when your deposits come from multiple sources, Social Security, a pension, maybe a little help from family, maybe a small side income, it creates complexity that automated systems don't always handle well. The good news is that protecting yourself doesn't require a law degree or a high-powered accountant. It requires awareness, it requires organization, and it requires taking a little time this year to make sure your financial house is in order. Let me give you a few practical steps that apply across all 5 of these transaction types. Start by pulling your last 2 years of bank statements and looking at them through the lens of what we discussed today. Do you see patterns of regular deposits that could look like structuring? Do you see family transfers that lack any explanation? Do you see income from apps like PayPal or Venmo that might not have made it onto your tax return? Next, talk to someone. This does not have to cost you a lot of money. Many seniors qualify for free tax preparation services. If you have a complex financial situation, especially with retirement account distributions or business income, a one-time consultation with a CPA might be one of the best investments you can make this year. Think of it as insurance for your financial life. Also, make it a habit to respond to all financial mail. I know the volume of mail can feel overwhelming sometimes, but a letter from the IRS or from your bank about your account is not something to set aside and deal with later. Deal with it right away. The longer you wait, the fewer options you have. And keep records of everything. Keep records of your deposits and where the money came from. Keep records of your withdrawals and why you made them. Keep records of any transfers between accounts. You don't need a filing system worthy of a law firm. A simple accordion folder with your monthly statements and any tax-related forms is enough. The goal is that if the IRS ever asks a question, you can answer it quickly and confidently. There's something else I want to address before we close today, because I hear this from seniors all the time and I understand why they feel this way. Some of you are thinking, I've never done anything wrong. I've paid my taxes my whole life. Why should I have to worry about this? And that is completely fair. You've earned the right to live without financial stress and government interference. But here's the reality. The IRS's systems don't know your story. They don't know that you worked 40 years and paid into the system honestly. They see data points. And right now, in 2026, they are looking at those data points more carefully than they have in years. Being informed isn't the same as being afraid. Knowing what they're watching gives you the power to make sure everything you're doing is clearly documented and above board, so that if they ever do look at your account, what they find confirms what you already know. You've done everything right. That is the goal today. Not fear, clarity. Because when you know what to watch out for, you can protect what you've worked for. I do want to mention one more thing before we wrap up, and it's important. There is a lot of misinformation circulating right now, particularly on social media, about the IRS freezing accounts, seizing Social Security benefits, and mass audits targeting seniors. Some of it is exaggerated, some of it is outright false. Not everything you see in your Facebook feed is accurate, and you should always verify information through official sources like irs.gov and ssa.gov before making any financial decisions. What I try to do on this channel is give you the real picture, what's actually in the law, what the IRS is actually prioritizing, and what practical steps you can actually take. Sometimes that's reassuring. Sometimes, like today, it involves some things that deserve your attention, but it's always honest. And I'll always tell you the difference between something you need to act on now and something that's just noise. So as we close today, here's what I want you to take away from this. The IRS is watching certain bank transactions in 2026 more closely than before. Seniors are not being targeted personally, but the patterns common in senior financial life, fixed income deposits, family help, side income, retirement distributions, can attract scrutiny if they're not handled correctly. Understanding what those triggers are gives you the power to make sure your accounts, your benefits, and your financial future are protected. Review your bank statements, keep your records organized, report all income, even the small stuff, handle retirement distributions carefully, and don't ignore correspondence from the IRS or your bank. If you found today's video helpful, and I genuinely hope you did, please share it with someone you care about, a friend, a spouse, a sibling, anyone who might benefit from knowing this information. And if you haven't already, hit that subscribe button and the notification bell so you're always the first to know when we release a new video. We put this content out for you because you deserve to be informed, you deserve to be protected, and you deserve to enjoy everything you've worked so hard to build. Take care of yourself, stay sharp, and we'll see you in the next one.